Hey everyone, and welcome to today's explainer. I'm just incredibly excited to guide you through this material today. We're going to look under the hood of this massive, kind of invisible machine that literally prices your mortgage, your car loan, and, your retirement accounts. For a lot of folks, the financial world feels like this total black box. But by the time we wrap up here, you're going to see exactly how the gears of this machinery actually turn. Okay, so let's just dive right in. $145 trillion. Take a second to wrap your head around that. That is where our story begins. That's the size of the global bond market. It's this quiet, humming engine that most of us literally never look at, yet it touches every single dollar in your financial orbit. I absolutely love this quote because it just hits the nail on the head. If you don't understand bonds, you don't understand money. Most folks who actually own bonds, they don't really know how they work. But I promise you, by the end of this explainer, you're going to understand exactly what every little move in this $145 trillion market actually costs you in hard, cold dollars. So here's our game plan for today. We're going to cover the trillion-dollar machine, the golden rule of bonds, the 2022 portfolio crash, the hidden multiplier known as duration, market warning signs, and finally, taking control of your cash. All right, part one, the trillion-dollar machine. Let's get the absolute basics down. At its core, a bond is really just a loan. That's the whole shebang. Instead of going to a bank, a government, or a company borrows money directly from investors, like you or me. You hand over a fixed amount, that's the principal. They promise you a fixed interest payment every single year, that's the coupon. And they promise to give your principal back on a specific date, which we call maturity. So it's just a piece of paper, right? But what makes it so mind-blowingly powerful is the sheer scale of the whole thing. Look at the US government, literally the biggest borrower on planet Earth, $2.88 billion. That is roughly what they pay in interest every single day. Just the interest. I mean, they spend more on interest than on national defense. And every single penny of that rate, it's set by this very bond market. Moving to part two. The golden rule. This is the physical law of finance you absolutely have to understand. So here is the golden rule. It's a lot like a seesaw. When interest rates rise, the price of existing bonds falls. And when rates fall, the price of existing bonds rises. They move in opposite directions every single time. Absolutely no exceptions. Let's actually walk through the math so you can see exactly why this happens. Let's say in step one, you buy a $1,000 bond paying 3%. So it pays you $30 a year. Pretty good. But a few months later, step two, the government issues brand new bonds at 5%, paying $50 a year. Now, if you want to sell your old bond, no one, and I mean no one, is going to give you $1,000 for it. Actually, think about it. Why would they, when they can just buy a brand new one paying way more? So in step three, you have to drop your asking price to about $600 just so your little $30 payout matches that competitive 5% yield. You still get your $1,000 at maturity, sure, but on paper today, your bond just lost a ton of value. Every disaster we're about to talk about is literally just this one rule operating at massive scale. Let's look at how this plays out in the real world. Meet Brian. He's buying a house with a $400,000 fixed mortgage. Now, banks don't just invent mortgage rates out of thin air. They base them directly on the 10-year US Treasury bond. Back in 2021, when rates were at rock bottom, Brian's monthly payment would have been $1,612. But cut to late 2023, when rates peaked, that exact same house, with the exact same loan amount, suddenly cost $2,877 a month. Over a 30-year loan, we're talking about a $455,349 difference. The bond market basically handed Brian a $500,000 invisible bill, and they didn't even send him an invoice. Which brings us to part three, the 2022 retirement portfolio crash. Let's see how this exact mathematical rule absolutely broke the gold standard of retirement. Okay, so for decades, the holy grail of advice for retirees was the 60-40 portfolio. You put 60% in stocks to grow your money and 40% in bonds to keep it safe. That bond half, it was sold to millions of people as the conservative, sensible default. It was supposed to be your safety seatbelt. So what does this all mean, and why did it completely fail in 2022? Well, in 2022, the Federal Reserve raised interest rates from near zero to over 4% in just 9 months to fight off inflation. Remember our golden rule, the seesaw? When rates rise that fast, existing bond prices plummet. And guess what? Rising rates are total poison to stocks too. The whole 60-40 hedge completely broke down because rising interest rates were destroying both stocks and bonds at the exact same time. The S&P 500 dropped over 18% and the broad US bond index fell 13%. The overall 60-40 portfolio lost about 16% in a single year. That seatbelt didn't catch anyone. It was literally attached to the same crashing car. And just look at those long-dated treasuries, down almost 40%. Insane. To really put that into perspective, consider this mind-blowing fact. According to an analysis out of Santa Clara University, 2022 was the worst year for long-duration U.S. bonds since 1754. Think about that. The United States literally didn't even exist yet. It was just 13 colonies, and the so-called safe sleeve of America's retirement portfolios was having its worst year in 268 years. All right, part 4, the hidden multiplier. We really need to talk about the danger of duration. Now, this is absolutely crucial. This one simple metric dictates your risk, and it's printed right there on every single bond fund's fact sheet. Duration. It's basically a rough estimate of how much a bond fund is going to lose for every 1 percentage point rise in interest rates. Yet, millions of retirees never even glance at it, mostly because they were just told, hey, bonds are safe, and they stopped reading. Let's look at how bond duration actually impacts your retirement savings. Take 2 retirees. They both have a $500,000 safe bond portfolio, and rates go up by just 1%. The retiree in a standard fund with a duration of 6, they lose $30,000. Ouch. But the retiree in a long-dated fund with a duration of 17, they lose $85,000. Same rate move, same $500,000, but a massive $55,000 difference in losses. And because bond funds never actually mature, they just constantly reprice every day, those losses show up right on your monthly statement and they just stay there. Duration is that hidden multiplier you literally cannot afford to ignore. On to part 5, market warning signs. Let's talk about predicting the economy. Economists rely super heavily on this thing called the yield curve. It basically plots the yield of U.S. treasuries across different timeframes. A normal yield curve slopes upward. So a 30-year bond pays around 5%, while a 3-month bill pays 3.71%. And the logic there makes total sense, right? You'd demand a higher term premium to lock your money away for 30 years, because let's face it, a lot more can go wrong in 3 decades than in 3 months. But occasionally, this curve inverts. That means short-term yields actually pop up higher than long-term ones. When this happens, the market is basically screaming that an economic slowdown is coming, which will force the Fed to cut rates. And here's the kicker. Here's why you should care. According to the Federal Reserve Bank of San Francisco, an inverted yield curve has predicted 10 out of the last 10 U.S. recessions since 1955. It's got a perfect 10 for 10 record. When this indicator flashes, it's basically the economy's ultimate check engine light. Finally, part 6. Taking control. Let's look at how to actually maximize your returns. Let's compare your cash yield options right now. The National Average Bank Savings Account pays a pretty dismal 0.38%. Meanwhile, 3-month Treasury bills are paying 3.71%, high-yield savings are up at 4.20%, and Series I bonds are paying 4.26%. Now, all of these options share almost the exact same safety profile. They're either backed by the U.S. Treasury or they're FDIC insured. But look at those yields. They are dramatically different. I-bonds, for instance, are pretty much the most direct inflation hedge available to regular savers, adjusting right along with the cost of living. Let's bring our guy Brian back for a second. If Brian keeps his $50,000 in a standard bank account, he earns a whopping $190 a year. But if he moves that exact same cash into 3-month T-bills, he earns $1,855 a year. Over 5 years, leaving his cash at that standard bank is literally costing Brian over $8,300 in missed interest, all because he isn't paying attention to Treasury yields. The people maximizing their money aren't necessarily smarter than you or me, they just stopped pretending the bond market was boring. And that brings us to the absolute ultimate question you need to ask yourself today. Seriously, go check this. What is the duration of your safe retirement funds? Look, the bond market isn't just something rich people do on Wall Street. It is the invisible machinery pricing your everyday life. So open up your fund fact sheet, Find that duration number. Let's stop treating finance like a black box and start seeing the engine that's actually running your money. Thank you so much for joining me on this explainer today. I really hope this connected some dots for you. And as always, keep learning.